Welcome to the daily update. We'll go over the action in the market for Monday, April 8th, and then we'll see how things look for Tuesday, April 9th. Well, happy Eclipse Day. I found myself humming the Cat Stevens song, Moon Shadow, there for a while. Even though I'm not in the US right now, I kind of paid attention to what was going on with all that and all the craziness, and people are freaking out. And somebody came out and said, well, once it turns dark, it's going to stay dark for 5 days. It's like, okay, I'm just going to take a big leap of faith here and say that's not going to happen. And from everything I can tell, it did not happen. But these are events where the craziness seems to just come out of the woodwork. Those people that are involved in the market, they kind of took the day off. It ended up being a pretty slow day overall. We didn't have any economic reports. We have the big CPI, PPI, the Fed meeting minutes, and just the whole shift with interest rates right now, geopolitical concerns. And so there'll probably be some excitement later on in the week. Hopefully the scenario will become a little bit more clear. But at least in Monday's session, we pretty much ended a little bit lower, but where we also ended after Friday's session. So nothing was really decided, but we still want to go through, look at the charts, try to see things as they're playing out day by day, and try to come to a conclusion as to where things are at. First, before I get started, I actually recorded part 3 of the proposed program video, but right near the end, there was some construction going on around me and some very loud noises. And I do all these take one. And so and then the noise lasted for a while. So I practiced putting part 3 together, but it's not posted yet. Those of you that are new, and even if you've been watching these videos for a while, there are a lot of different videos that I post. The real foundation of my analysis is the daily video, where I see the other videos kind of feeding into the daily video. That's how I felt concluding things just day by day is the best way to get a real good handle on what's going on in the market. Yeah, takes more time, takes more effort, but if you're really into this and if you're managing a pretty sizable portfolio, my goodness, spending 30 minutes a day or so analyzing things could really be to your benefit. And also, I'm still playing whack-a-mole like crazy on Rumble. I get these folks that attended some kind of webinar or something and said, go out and pretend that you're an expert in YouTube and Rumble and copy and paste this crazy message and you'll get all these people that want your help. And I delete those right away. Also, sometimes when I respond to your comment and then you respond back, there can be a delay in that as well. All right, let's go back and talk about what happened. We had a pretty flat open. The futures were negative, slightly negative, and then as we got closer to the open, we actually turned over positive about 90 minutes or so before the open, but still nothing all that major. And we did see prices actually go up shortly after the open, but we hit resistance at around the 52.20 level. And then things just came back down after that. We fell back to the unchanged level and then chopped sideways. And we were pretty much positive for most of the day. And then there was just a little bit of a drift off right at the end, but we're still above the 5,200 level. We were down 0.04%. Volume was below average. We're positive in the bigger picture, but we're vulnerable right now with how things are looking because we had such a good run to the upside. We're also seeing this scenario that had helped things go up kind of being questioned right now. And the hope is that things that are going to be released this week will shed some more light on that. And then, of course, all the different geopolitical events that are happening and the astrophysical events like the eclipse that seem to come and go. And if I remember back to the Hale Bopp thing, that happened. It was done. It was over. And then like a week later, we found out about this cult in Southern California that committed suicide, and they were all wearing the same clothes and the same shoes, and very strange. All right. Some comments, mid caps and small caps. They had on a relative basis, they had a pretty good day. They were up more than the other areas like the S&P and the Nasdaq 100. And banks, there's a little bit of front running going into the financial sector because earnings are going to be coming out later in the week. Oil was down slightly. It's still in the 86 range, but it fell to 86.50. And we just have our 150 and 200 period simple moving averages that are extreme positive. All the other short and intermediate term indicators have now fallen off of being extreme positive. The parabolic SAR is still negative. And then we're still wondering what's going to be the change to the current scenario. The market had been under this impression that the Fed is likely done raising rates. And that was backed up by comments coming out of the Fed, and for a while backed up by economic reports, and that they could possibly cut rates 3 times in 2024. Then we had stronger than expected economic reports. Then last week we had some Fed officials coming out saying, well, maybe we're not going to raise rates in 2024. And then you have some black swan event that could at any time come into the economy and change everything. I'm not hoping for that. We just always have to be aware that those things can happen. And so now this Goldilocks type scenario is being questioned a little bit. The dollar was down slightly, and interest rate, they're going up. And it's 4.43% with the 10-year yield. And that didn't seem to really impact, especially the small caps in Monday's session. We still have the yield curves that we follow that are inverted. We actually ticked up quite a bit as far as sentiment. We're at 66 now, where after Friday we were at 61. Our trend is still negative. The red line is still below the green line, and it's a weakening trend. We've already gone in a trendless environment where the ADX has dropped below 20 in the short term, and we're getting really close in the intermediate term. Because of the really non-event Monday session, the bias is mixed, and I'm keeping our momentum at mixed. The market is still at a tipping point. We didn't have any economic reports, so there's no charts to show you. Here's the insider transactions ratio. This comes out once a week or so, and these are legal insider transactions as opposed to the illegal kind. This is the owners and CEO and corporate officers, and there's a delay in this, but when they're doing a lot of buying, that is more bullish. When they're doing a lot of selling, that tends to be more bearish. We're not really getting any kind of an extreme reading. And then this is looking at the bottom-up consensus of earnings per share revisions, where you look at the top 10 stocks, they're revising those earnings up. And if you take the rest or the S&P together, they're actually coming down 1%. And then if you take the other stocks that are included in the S&P 500, and they're actually revising them down a little bit more, down 6%. And this is according to Goldman Sachs. Short interest, and this comes up every once in a while, and I like to explain this a little bit. These are folks that they get into the market by selling because they're hoping to buy it back at a lower price later. And that's called short interest. And it's really kind of historically low. There are so many other vehicles that I personally use to take advantage of things going down. There's a lot of risk when you just flat out go short into the market. And you have unlimited risk at that point, because theoretically the index could go up infinitely, where when it goes down, it could only go to 0. But we want to keep an eye on this. And number one, when it gets kind of high, that means folks are more negative on the market. But at the same time, we want to watch this because these are like built-in buyers. Short interest rules are a lot more stringent than if you just go long. If you're losing in a short position and you're not in an ETF or an inverse mutual fund or inverse ETF, you can ride that out. That's the most you can lose in that kind of a position. Well, you're unlimited here, and so you have to get out. And when you sell to get in, you have to buy to get out, and that produces a sideline of buyers. And sometimes when we have a short cover rally or a short squeeze, the market's going up and it seems to just be going up and up and up out of control. That's what we call a short covering rally or short squeeze or something like that, where it's just shooting up and it's like, wow, that's just, it's these folks that are having to get out. All right, then we look at kind of a comparison between the NASDAQ 100 and commodities, which have been doing better now, and they're starting to kind of improve here. We think there's a potential that we're entering into another phase of the economy where it's okay for commodities to do well, and this tends to be more inflationary, but they can also go up in a more pro inflation environment where inflation may be there, but it's not really extreme. But now that's been thrown into question with some of these stronger than expected economic reports, because now it's maybe inflation's getting too strong. And that's what we're hoping to have a little bit more clear at the end of this week. And we look at the money market flows and just compare it with what the Fed funds target rate is. Now, one thing that sometimes I hear people do is they say, "Whoa, look at all this money in the money market. That's like fuel on the sidelines to help the stock market." And I like to go back and explain that no, that it can mean that to a degree, but really all this means is that folks are taking their money out of banks where they're getting a very bad or very low return, and they're putting it into a money market where they're getting a better yield with that money. And that's as far as it's going to go. They're doing it strictly from the yield basis there. Some of that money could end up going into the stock market, but it's not always a direct correlation between the two. Then we look at the asset classes, the valuation versus history. When we're up here with the black line, that's the S&P 500, where we are expensive on a valuation basis. Where if you look at commodities, even though they've been going back up, they're still considered to be cheap. So there might still be some more room to run to the upside. Didn't really find anything on Twitter that was interesting. This is a cartoon from Dan Bird that's in a free newsletter that you can get. And since I refer to Goldilocks a lot as just, not too hot, not too cold, and then we ran into some problems last week, I thought this was kind of a clever little cartoon. This has not been updated for a week now. I went and checked, but we're kind of following along these cycles. Don't really know if there's anything to it or not, but we could see a bit of an upward move going into about the 10th. So this is a couple of days of cycle positive action, but then we might see things pull down a little bit going into about the 24th of April. Here's our chart where it's kind of strange. We really didn't have much of a move right at the open, and we just kind of went flat. We tried to break to the upside. We got just about to 52.20. Then we fell back. Then we danced above the unchanged level, but then we saw a little bit of selling going into the close. Here's the intraday chart. Really not an awful lot happening right now. Things are pretty quiet. It's the calm before the storm, possibly. We are still looking a little bit better with the blue line and the red line. The growth is on top of value right now. Intraday, we came down a little bit with the growth to value ratio for the S&P, but it has been showing some improvement lately. And then our end of day charts, growth was down where value was up for the large caps. It was up, but up less for the mid caps and up less for the small caps. So the strength that we saw, especially in the small caps, and mid caps had a pretty good day too. It was more in the value area, not in the growth area. So that's not helping our growth to value ratios for the small caps or the mid caps all that much. And we're not really improving right now with the S&P growth to value ratio. We're not showing much of an improvement here with discretionary to staples. We ticked up a little bit and we're still on a longer term uptrend, but we're just chopping more or less sideways lately. Large cap growth was up just a little bit, 0.02%, but it's still in a longer term uptrend. It's well above all the moving averages here. And then looking at our trend, we are declining with the ADX. We're getting really close. We're at 20.12. If we drop below 20, that's a static number definition for a non-trending environment. The red line, even though it's declining, it's still above the green line, which is also declining. We're already below 20 with our short-term ADX. We also see the green line below the red line, and volume continues to drop off. We saw one above average volume day, and that was the decline last Thursday. For the last week, all the other trading days have been below average. Sentiment. This is a weekly chart that we look at where they take a lot of different measures and put them together, the latest reading still shows sentiment being extreme positive. Here's another look where it's coming down just a little bit, but we're still getting pretty extreme positive with this sentiment indicator. This has not been updated yet. Hopefully in the next day or two, this will be updated, but the latest reading was very high. It was above 4 at 4.43. That's a very high reading for this indicator. And I haven't shown this in a while because we've been flatlining with the Ulcer Index, but we're starting to come back up. It's seeing a little bit of fear coming into the market. Not enough to go above the moving average, but it is starting to pick up. We actually came down with the VIX when we look at the line chart and the bar chart because it was a pretty quiet day. We also saw volatility of the VIX decline, but still above the moving averages. The momentum of the VIX continues to be going up now. And this was actually updated. We were down with the daily chart of the equity put call ratio. We're kind of topping out possibly with the 5-period equity put call ratio. The risk premium just at the upper end of this band, so showing that there's a little bit of volatility risk premium in the market right now. The advanced decline line, we did turn back up based on price and volume. We're still holding up longer term. We're above the advancing moving averages. We saw more new highs than new lows. We're still trailing off with our 5-period because we're pegged at the top here. And so any kind of a decrease in the new highs is going to make this go down. And we're also seeing this decrease with the 10-period moving average. We're still above 0 and going up with the advanced decline ratio. Accumulation distribution, we were right on the moving average after Friday. With the slight downward move towards the close, we're just a little bit below it now. So this tipping point is tipping a little bit more negative. And we're also looking more negative here with the chicken money flow. We did see a negative divergence as the S&P was going up, the chicken money flow was going down, and we're negative right now. It's not really continuing to decrease for the time being, but this is causing some concern. Also, the Chaikin oscillator is below 0 and declining. That's negative. Not really big changes here with our advanced decline line studies. We were up slightly with the NYSE common stock, a little bit with the S&P, the mid caps, and the small caps are trying to bounce off their moving average. Here's our daily chart. We're still at this pivot point right now. So this is another tipping point that we're keeping an eye on. This is pretty significant. If we can go back above this, that would turn more positive. If we break below it, that could turn more negative. And then we might be watching the 50-day moving average. On the bottom, we are below average with volume. Here's the 20-period moving average. We're still above that. So in the short term, we're hanging in there for right now. We lost that after Thursday. We regained it after Friday, and we're still above it, even with the slight down day. We're kind of at the top end of the mini rainbow here with our 20-period simple moving average of the open, high, low, close. This may be providing some support in addition to what we're seeing with the 20-period regular moving averages. And we want to keep an eye on the 50-period moving average. Just in case we start to fall, this might be the next level of support. The Bollinger Bands, we're still above the midpoint. We lost that after Thursday, regained it after Friday, and still are above it after Monday. We're slightly above the midpoint with the percent B indicator, so that's a little more positive. And we're keeping an eye on our double and triple exponential moving averages based on 20 periods. We're dropping below, and the lines are starting to roll over. That's showing that the short-term trend is vulnerable right now. Now, we could get that back and go up from here. But right now, we're just seeing some weakness creeping in. Not really much of a change here with our 20, 50, and 200 period moving averages. They did go up since we saw a little bit of strength for most of the day. We're just a little bit negative with the force index, so that's slightly negative. We're not extreme now with the stochastics and any of the time frames that we look at. And we're just a little above the midpoint with our standard deviations chart. So that's leaning a little more positive. We're just at 0, right? Well, just a little bit above 0 right now, even though we declined with the balance of power. That's just barely positive. And we continue to be dark blue with the go, no-go bars. That's positive. We're a little above the midpoint with our highest high value, so that's more positive. The TTM squeeze, though, is continuing to decline with the darker shade of blue here. And so that's actually showing some weakness. And we're also keeping an eye on our double and triple exponential moving average based on 50 periods. We've been chopping sideways here. We're starting to see some weakness in the red line. That's the triple, and it moves faster. If it drops below, that would just show that there's some weakness coming into the intermediate term trend. We did decline with the ease of movement, but we're still above zero. We're flatlining with the Arun indicator. Saw a little bit of a tick up with the McClellan oscillator for the S&P, but we're still below zero. So with our summation index based on price, we're declining because we're below zero with the McClellan oscillator, and we're also declining based on volume. Now, one thing that you may want to look at is I'm always trying to point out negative divergences where we're making a lower high here. Okay, fine. But we never came back up to a high reading like we saw based on price. The reason I don't really point this out on this chart is the top indicator and the bottom indicator are completely different indicators, and it's not an apples to apples type of comparison with each other. So that's why I tend to not point that out as much. We're also showing a bit of an improvement with the NYSE McClellan oscillator, but we're still below zero. So when we look at the summation index, we're declining based on price and volume. We turned up a little bit based on price with the Swenlin trading oscillator, but we're below zero. We continue to decline based on volume. We're also dropping off with our oscillators, with the PMO now declining. We're declining based on price. We're also declining based on volume. We saw a little bit of a turn up with the PMOs that are rising. We're flattening out with the buy signals, and we're still extreme positive with the PMOs above zero. We continue to be positive with the Elder's Impulse system for the S&P. We continue to be negative. We continue to be negative with the parabolic SAR. When we look at our oscillators, they're drifting now. With the slope oscillator, the MACD is declining. All of our oscillators across the board are now declining. And I pointed this out in the What to Watch video because these are moving average based and some of these higher levels are now being included into the calculations. You can't help but see this trailing off. That's part of calculation. Now, a lot of people see this and go, ooh, sell, 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 go short, go short. And then that ends up being more like a self-fulfilling prophecy. We're still above all the moving averages here. And we ticked up a little bit with the bullish percent index, but we're still declining overall. We want to see some more strength in this to turn back more positive. This is actually on a sell signal now since it dropped below 70. And if it keeps declining, that's going to turn things more negative. And we turned up just barely with the NYSE bullish percent index, and we're above 50. So this is positive. We're still negative with the NASDAQ 100 bullish percent index, even though it did turn up slightly. The money flow ticked down just a little bit, but it's still above 50, so that's positive. We declined with the ultimate oscillator, and below 50, that's negative. And we're still seeing this longer-term negative divergence with the vortex, even though it is showing a little bit of an improvement here. We're looking a little better here with the RSI, even though we ticked down with the 14, we were flat with the 9, but the readings going back to the beginning of November pretty much have always, except for a couple of exceptions here, have been above 50, and that just shows good, solid momentum. We're still positive with the on-balance volume, even though it did decline. We're above the advancing moving average. We're crossing back above 50 with those stocks above their 20-period moving averages inside of the S&P. So this is showing some improvement. We also turned up a little bit with the stocks above their 50-period moving average. And we turned back up a little bit. This is showing a little bit better momentum. Now, we were trailing off here, and we could trail off again, but the longer we can stay up in this area, that just shows longer-term momentum. And we saw a little bit of an upturn here with our 200-period moving average study after giving us a really extreme positive reading. But when we look at the Copic curve, another momentum oscillator, it is negative. We were flat with the the Sean trend meter. We're still looking okay here with the Heiken Ashi. We actually had an open candle. We're negative with the Kegi, but pointing up since it's red. The Renko chart, it went crazy after Friday's session. Now it rethought about things and is looking more positive. But the three-line break is looking more negative. So we're seeing some contradiction here. We're still keeping an eye on this R1 level, about 5110 to 5111. And possibly enough time has passed. Will this end up providing support if we see some weakness? If we can break further above this, of course, that would be more positive. We're still looking extreme with our 150 and 200 period moving averages. And we're going back to looking solidly positive according to the Keller market model with the S&P, mid caps, small caps, and the NASDAQ 100, and on all different time frames. We're still looking negative based on bonds when you look at their price. We're also negative with the CRB or commodities longer term. We had a lot of positive things happen earlier in the day, and then the S&P did cross below 5,200, but it recaptured that as we were coming into the close. Still holding up okay when we compare the S&P index to the S&P equal weight index, and saw a little bit of a decline here, meaning that the broad market slightly outperformed the mega caps. And we're still at the tipping point with the Dow. Nothing changed here. We were down 0.03%. We're on a moving average. We're also on a pivot point as well. But we continue to be negative with the diamonds when looking at the Elders Impulse system. We're also just a little bit above the pivot point where the NASDAQ was up slightly. This is still, I'm calling this a tipping point. We were also down just a little bit with the NASDAQ 100. So we've dropped a little bit below this pivot point now. We want to be watching this 50-period moving average to see if it provides support. We continue to be neutral with the QQQs when looking at the Elders Impulse system, but the momentum for the NASDAQ 100 continues to be negative. We're still, well, we actually dropped a little bit below the 20-period moving average here. We're still above the 50. Longer term, we're still in an uptrend. It would be more positive if the Qs could regain this 20-period moving average after, like it did on Friday. Small caps just, I mean, they had a good day, but they're just like treading. They go up strong and then they go down strong and they end up really not going anywhere. We switched over to positive with the Elders Impulse system for the small caps, and we're crossing back above 50 with the RSI, with the Russell 2000 small caps, still above the moving average and a longer-term uptrend, but the momentum continues to be negative for the small caps. The mid caps are a little bit above the pivot point here, so that's showing some slight improvement. And they've turned from being neutral over to positive with the Elders Impulse system for the mid caps. Apple was down and continues to be in a downtrend. Tesla is down and was actually up almost 5%, but it has a lot of damage to repair. Nvidia trailed off, was down about 1%, and after coming out with earnings and then being the cool thing to do, it really hasn't been going anywhere all that much lately. The FANG index is also going sideways, but we're still above the 50-period moving average, and the longer-term trend is still positive. The financial sector was up. This is a little bit of front running ahead of the bank's earnings. And the dollar ended up actually was declining. It looks like it was up here because this is a more of a live chart that works 24/6. And so sometimes by the time we closed with stocks, the dollar was down slightly. And the longer term, we've come back down to this trend line and we're trying to bounce up off of that if there's more strength. And the dollar, oil did fall back a little bit, but it has been rising due to geopolitical tensions. And when we look at the S&P and compare it to the rest of the world, the short-term correlation continues to drop off, and we're starting to head lower with the longer-term correlation. And we were up slightly with the 10-year yield. Not slightly, we were actually up quite a bit. And this is causing some concern. Why do interest rates keep going up? Why are stocks not really reacting to that? So we were down based on price. When you look at the ETF, seeing not really much of an improvement here with the Qs to S&P. We did turn up with discretionary to S&P, but we're still below a declining moving average. We saw a little bit of a turn up when we look at large cap growth versus large cap value. So the large cap showing some improvement, a little bit of a tick up with the mid caps, and we're kind of flatlining now with the small caps. Haven't shown this in a while in this video. This is the Staples to S&P 500 ratio. When this is going down, that often gives good support to the S&P, and we're continuing to break down with this ratio, but we're not seeing an awful lot of follow-through with the S&P at the present time. So what's our outlook for Tuesday? Earnings season will begin this week. Later in the week, that's when the banks are going to be coming out. The technicals were still positive, but we're still at this tipping point. Nothing was really decided in Monday's session. We're going to get the NFIB small business optimism. Some people think that's not a very important report. I like to keep an eye on it. Keeping an eye on all the different geopolitical events, worried about escalations in the Middle East and craziness, fallout from the eclipse, and anything else that we haven't really even thought about. Then on Wednesday, we're going to get CPI. That's going to be released before the market opens. And then at 2 p.m. Eastern, that's when the Fed meeting minutes are going to come out. Then on Thursday, we're going to get PPI. And then on Friday, we're going to get consumer sentiment. And don't have anything blocked here yet because we haven't hit Wednesday as of right now. Seasonally, we are neutral to negative across the board with the Dow, S&P, and NASDAQ. We show a little bit of positive seasonality with the election year. We're ticking up just slightly with the green dashed line. And this is a newer chart to update what we've been doing with the S&P. That's this purple line here. And then to kind of twist it around a little bit, this is a different chart than what I've shown before. Instead of saying, okay, what's the average during an election year? That's the black line, and that's what we were following in March, and that we were going in the opposite direction of that. So what Jeffrey Hirsch did is he went back and he said, okay, just give me the best first quarter, and we're going to plot how we're doing against that. So it kind of switched it around a little bit. So maybe this is something that we can follow for a little while now that might match up a little better with seasonality. And we're just not really following this seasonal chart according to what Carson has come up with. Tuesday is one of the more negative days, at least when you compare it to 2023. Not much of a downward move. Wednesday ends up being the most negative day of the week. And then we do see some possible, well, here's some strength going into about the 10th of April, and then a little bit of weakness going into tax day. If we do see strength in April, it tends to come later on. At least historically, since 1985, that's been what has happened. This is also going from 1976 up to 2023. This is what the S&P has been doing, not including the recent declines here, and then comparing it whether it's a non-presidential year or an election year. April is one of the stronger months, not only in the US, but it's also stronger looking on a global basis. It tends to be the most positive month of the whole year when you take all stocks around the world together. No matter how you measure April, we are positive when you look at it from different angles. And we're up 11 out of 18 times in April. We're down 7 out of 18 times. So we're up 71.6% of the time with an average return of 1.5%. Then this came out over the weekend, and it usually comes out a few days after the start of a month. This is Tom Bowley. He operates a site called Earnings Beats. He also is a video contributor to Stock Charts. And he says that according to his research, April is a bullish month. Industrials tend to be weak, where energy tends to be hot, and that's kind of how it's been going. We're still in this positive time here, according to what he's found for the S&P. Then we hit a period of some weakness, and then we tend to finish off the month looking stronger. So the warning signs, the equity put call ratio is back to going up again. It's nice to have some updated charts there. The parabolic SAR is negative. The bullish percent index for the S&P has dropped below 70. It did tick up a little bit, but I have a moving average over top of that, and it's continuing to go down. The bullish percent index for the NASDAQ 100 did tick up as well, but it's still below 50, so it is negative. The Chaikin money flow and the Chaikin oscillators are both negative. The ultimate oscillator is negative. The Kopic curve is negative. We're still seeing the growth to value ratios, both with the small, mid, and large caps. All of those are showing weakness. And then we have some negative divergences. Now, pretty soon, if we really start to see a decline from here, I'll be able to take this off, because now the oscillator is going down. And if we see that followed by price, that would take the negative divergence away. The small caps are still the lagging index behind all the other indexes. Discretionary and staples, they're also not really performing all that well. When you look at the comparison between the two, the transports are still negatively diverging, and the momentum for the NASDAQ 100 is still negative. On the positive side, the Vortex, it's still positive, but it has been drifting, even though it ticked up a bit in Monday's session. Large cap growth is still holding up okay. It's kind of underperforming. It's certainly not outperforming right now. And the financial sector is positive. So our conclusion, and this is the same as what I came up with for Monday's video, because we really didn't see much of a change. We're positive when you take everything together, but we are at a tipping point. In the short term, we're seeing some mixed signals right now. We're also seeing some mixed signals in the intermediate term, but we're still positive for the time being. We are positive in the long term, but we still have the 150 and 200 period moving averages that remain extreme positive. Thank you. I hope you have a really good day. I hope you had a good eclipse day, and I hope your Tuesday ends up being a very good day as well. And I will talk to you in the next video.